Imagine you are standing on a street corner in 1974. The air smells like leaded gasoline and heavy smog. Lines at the gas station stretch for 3 blocks. People are frustrated and tired. Everything is getting more expensive by the week. A shocking fact from that era is that inflation reached nearly 14% in just a few years. You probably thought your savings were safe in a bank account, but the value of that cash was melting away like an ice cube in the sun. To visualize that, imagine a stack of $100 bills tall enough to reach your waist. After just a few years of that inflation, that same stack would only buy enough to reach your knees. How does a person survive an economy that is literally eating itself? This is the question that kept a young Warren Buffett awake at night. He was watching his beloved investments struggle. His main company, Berkshire Hathaway, was still making clothes back then. It was a tough, gritty business. The machines were old, loud, and incredibly expensive to maintain. Every time inflation went up, the cost of raw cotton went up too. But the customers refused to pay more for a simple shirt. The profit just disappeared. Buffett realized he was facing a monster. He called this monster the corporate tapeworm. It is a vivid image for a reason. A tapeworm does not care how hard the host works. It just sits there and consumes every bit of nourishment. In a business, that nourishment is capital. If a company has to spend $1 million to replace a machine that used to cost half that, it isn't growing. It is just trying not to drown. This was the central tension of the decade. The stock market became a graveyard for companies with high overhead. Buffett saw the writing on the wall. He knew he had to stop buying cheap companies. These were businesses that looked like bargains but required constant cash to stay alive. Instead, he started looking for something much rarer. He wanted businesses that did not need a lot of inventory. He wanted companies that could look a customer in the eye and say the price is higher today. He wanted the customer to say okay and pay anyway. This transition was not easy or obvious at the time. Many of his peers were still looking for deep value in heavy industry. They were buying steel mills and car plants. They were buying the very things the tapeworm loves to eat. Buffett was moving in the opposite direction. He was hunting for brands and secrets. Finance people still go back and forth on whether this was a calculated masterstroke or a desperate pivot to save his skin. Some analysts argue he simply followed the path of least resistance. Others believe he saw the future of the American consumer before anyone else. Either way, the result was a total shift in philosophy. He began to focus on what he called economic goodwill. This isn't something you can see on a factory floor. It lives in the mind of the consumer. It is the reason people choose a specific brand even when it costs more. This shift would eventually lead him to a small candy shop in California. That shop would change everything. It would provide the blueprint for the next 50 years of his career. But first, he had to survive the fire of the 70s. He had to prove that his new theory could actually work in the real world. Imagine you are peering over Charlie Munger's shoulder in 1972. He is looking at a balance sheet for a California chocolate company called See's Candies. At the time, the business was small. It only made a few $1,000,000 a year, but it had a fanatical following. The owners wanted $30 million to sell the whole thing. Buffett and Munger did not want to pay a penny over $25 million. This was a massive moment of tension. They almost walked away over a tiny difference in price. Yeah, for two guys who loved a bargain, $25 million felt like a fortune for a candy shop. Eventually, they gave in and wrote the check. It would become the most important $25 million they ever spent. You watch a husband walk into a See's shop on Valentine's Day. He is looking for a gift for his wife. He sees a box of chocolates. If that box cost $10 last year and $11 this year, does he leave? Does he go home and tell his wife he loved her less because of a price hike? Of course not. He buys the box. He doesn't even think about the cost. This is the pricing power secret in action. Most businesses have to fight for every penny. If a gas station raises prices by 2 cents, people drive across the street. But See's had something different. They had a moat made of brand loyalty and sugar. They could raise prices every single year on the day after Christmas. No one ever complained. You might think $25 million sounds cheap today, but back then, it was a huge bet on something invisible. It wasn't about the kitchens or the trucks. It was about the feeling people had when they saw that white box with the black logo. Buffett realized he didn't need to build more factories to make more money. He just needed to own the brand that people trusted. Analysts still argue about whether See's was a lucky break that made Buffett, or if he would have found the secret elsewhere. Some say it was the perfect storm of a great brand and a booming California economy. Others believe Buffett's genius was simply staying out of the way. He let the management keep doing what they were doing. He just collected the cash. That cash was like a golden waterfall. Since the purchase, See's has sent over $2 billion in profits back to Berkshire Hathaway. That is enough money to buy a fleet of private jets or several professional sports teams. Buffett used that money to buy even bigger companies. He used the profits from chocolate to buy insurance companies and railroads. You see, this wasn't just a sweet deal. It was a masterclass in inflation proofing. When the cost of sugar or milk went up, See's just bumped the price of a box. The customer stayed. The profit margins stayed. The tapeworm of inflation couldn't touch them. While other companies were struggling to pay for new equipment, See's was printing money. This experience changed Buffett's entire worldview. He stopped looking for cigar butts, those dying companies with one last puff of value left. He started looking for quality. He wanted businesses that could survive a world where a dollar buys less every year. You realize this is the ultimate weapon against a shaky economy? If you own the thing people must have, you don't fear the rising tide of prices. You just float on top of it. By 1977, the global economy was a mess. Prices were jumping every month. People were confused and angry. Buffett decided to sit down and explain the cold, hard math to everyone. He wrote a famous piece for Fortune magazine. It was titled, "How Inflation Swindles the Equity Investor." This wasn't just a regular article. It was a warning to every person with a retirement account. Imagine watching a runner on a treadmill. They are sprinting as fast as they can, but the treadmill is moving backward just as fast. That is exactly what inflation does to a business. Even if a company grows its sales, the treadmill of rising costs keeps them in the same spot. You notice that the real return for the owner is often basically zero. It is like working all day for a paycheck that only buys a single loaf of bread. Buffett showed that most companies have a ceiling on how much they can earn. He called it a sticky return on equity. Most businesses back then earned about 12% on their capital. That sounds okay on paper, but if inflation is 7% and taxes take another chunk, the math turns ugly. The tapeworm eats the rest. There's still a real disagreement on whether Buffett's math in that article was too pessimistic for the long run. Some argue that he didn't account for how technology would eventually lower costs. Others believe his equity bond theory is the most honest look at the market ever written. He argued that stocks are basically bonds with a coupon that doesn't change much. When inflation rises, the value of that bond has to drop. This created a lot of tension in the investing world. People wanted to believe that stocks were a perfect hedge against inflation. Buffett told them the truth. He said they usually aren't. Unless, of course, they have that secret weapon of pricing power. He explained that a company needs two things to survive. First, it needs the ability to raise prices easily. Second, it needs to be able to handle more business without spending a fortune on new equipment. Most companies fail both tests. You look closer at the typical American business and see a trap. Think about a big utility company. To serve more people, they have to build a new power plant. That costs a mountain of cash. By the time the plant is done, inflation has made the construction twice as expensive. The company has to borrow more money just to stay in the same place. They are essentially running to stand still. Buffett was basically telling the world that their favorite stocks were hiding a secret. He was pointing out that growth can actually be a curse. If growth requires more and more expensive machinery, it is just a faster way to go broke. You realize that a company with no pricing power is just a victim of the calendar. This manifesto was a wake-up call. It forced investors to look at the moat around a business. A moat isn't just a fancy brand name. It is a financial shield. It protects the company from the invisible tax of a devaluing dollar. Without it, you are just waiting for the treadmill to throw you off. This realization set the stage for his biggest bets yet. He stopped looking for companies that made things. He started looking for companies that owned the customer's mind. After the dust settled on the 1970s, the world changed. The 1980s arrived with bright colors and a booming stock market. But then Black Monday happened in 1987. The market crashed harder than a dropped piano. You see the chaos on the trading floor through old news clips. Most people were terrified. Buffett was just getting started. He began buying shares of Coca-Cola with both hands. This was a massive move that showed his confidence in the future. At the time, many people were confused. Why buy a sugar water company? It seemed boring, but Buffett saw that moat again. Think about the scale of a brand like Coke. Every day, people around the globe drink over 1 billion servings. If the company raises the price by just 1 penny per serving, that is an extra $10 million in profit every single day. That is enough cash to stack as high as a skyscraper every few months. The customer barely notices a penny. That is the ultimate pricing power. There was plenty of tension during this era. Critics thought Buffett had lost his touch. They said he was stuck in the past. But he knew that a brand like Coke was immune to the tapeworm of rising costs. If the price of aluminum for cans went up, Coke just adjusted the price. The loyalty of the drinkers was unshakable. Fast forward a few decades. The world moved from soda to smartphones. In 2016, Buffett made a move that shocked the financial world. He started buying Apple. For years, he had avoided tech stocks like the plague. He said he didn't understand them, but then he looked at the iPhone through his sees candies lens. You notice a teenager standing in line for the latest phone. The price tag is well over $1,000. If Apple raises that price by $50, does the teenager leave? No. They want the ecosystem. They want the blue text bubbles. They want the brand. Analysts still argue about whether Apple is a tech company or the world's most successful luxury goods brand. Some say the hardware is just a delivery vehicle for a high-margin service business. Others believe the brand loyalty is a psychological trap that customers enjoy. Whatever the case, the math worked perfectly. Apple became the biggest winner in the history of his company. It provided a shield against the rising costs of the 2020s. When supply chains got messy and parts became expensive, Apple kept its margins high. They didn't have to beg for customers. The customers came to them. You realize that the pricing power secret had scaled up. It went from a small candy shop to a global tech giant. The principle remained exactly the same. The best defense against a shrinking dollar is a product people refuse to give up. It doesn't matter if it is a piece of chocolate or a piece of glass in your pocket. If the seller can dictate the terms, the owner wins the inflation war every time. This realization leads us to the present day. The economic stakes have never been higher than they are right now. You look at the headlines today in 2026 and it feels like a bit of a loop. Prices for insurance are up. Rent is high. The cost of a simple cup of coffee makes you do a double take. Reports at the time showed that the global economy was still shaking off the jitters of the past few years. You notice that the Oracle of Omaha hasn't changed his tune one bit. He is still sitting on a mountain of cash that could literally fill a football stadium to the rafters. This record-breaking cash pile is a major point of tension in the markets. Why is he waiting? Some analysts argue that he is bracing for a massive correction. Others think he simply hasn't found a company with a moat big enough to survive the next decade. Finance people still go back and forth on whether holding that much cash is a brilliant defensive move or a missed opportunity for growth. But if you listen to his recent warnings, he points to one specific asset above all else. He often says the best thing you can do is invest in yourself. You trace his logic and it makes perfect sense. If you are a world-class surgeon or a brilliant lawyer, your talent doesn't care about the value of the dollar. People will always pay for your skill. They will pay you in whatever the current currency is. Your ability to provide value is the only thing that the corporate tapeworm can't touch. You see this reflected in his current portfolio too. He continues to favor companies that don't need to rebuild their factories every 5 years. He likes businesses that have already done the hard work of building their brand. He is betting on the idea that human nature doesn't change. People will still want their iPhones and their favorite snacks. They will still want the reliability of a trusted insurance provider. The strategy is deceptively simple. You find a business that can raise prices. You find a business that doesn't need to spend all its profit on new machines. Then you just wait. This patience is his real superpower. While everyone else is panic buying gold or trying to time the next big crypto wave, he is just watching the cash flow in from his pricing power machines. The takeaway for all of us is pretty clear. In a world where prices are always climbing, you want to own things that are indispensable. You want to be the person that people have to call. You want to own the product that people can't live without. Inflation is a thief that works in silence. It steals your purchasing power while you sleep. But if you hold assets that have a direct line to the consumer's heart or mind, you can stay ahead of the game. It is a lesson that took Buffett 70 years to perfect. He went from a kid selling gum door to door to the richest investor in history. He did it by realizing that math is just as important as psychology. He learned that a box of chocolates can be a better hedge than a bar of gold. You realize that the secret to surviving inflation isn't about being clever with your bank account. It is about owning a piece of the things the world actually needs. The world of money is always shifting and changing under our feet. It can feel overwhelming to keep up with the cycles of inflation and the constant noise of the stock market. We really hope this deep dive into the pricing power Starkula's secret gave you a bit of clarity for your own financial journey. It is always a good idea to step back and look at the bigger picture like the Oracle of Omaha does. We would love to hear from you down in the comments section today. Where are you watching from right now? The world is a big place, and it is always fascinating to see how these economic stories land in different corners of the globe. How is the current economic situation feeling in your neck of the woods? Whether you are seeing prices jump at the grocery store or you are feeling steady and secure, your perspective adds a lot to the conversation. And while you are at it, tell us about your upcoming plans for the rest of the year. Are you looking to sharpen a new skill or perhaps making a big move in your career? If you enjoyed this look at the history and strategy of Warren Buffett, please consider hitting the like button on this video. It really helps the channel grow and lets us keep telling these stories. You can also subscribe and hit the notification bell so you never miss our next dive into the world of finance and economics. We have a lot of exciting topics lined up that we think you are going to find really useful. Thank you so much for spending some time with us today. We truly appreciate your support. Take care of yourself, stay curious, and we will see you in the very next one.